comments contained in this podcast do not constitute legal advice. The opinions herein are the opinions of the speakers and not the official opinion of the Hodgson Russ law firm. Hey there, tax fans. Welcome to State Tax Talks with me, your host, Joe Tantillo. I'm a tax attorney at the Hodgson Russ law firm looking to explore the nuances of state and local tax law. Here on the show, our goal is to keep tax informative, simple, and fun. So if you're ready to talk tax, turn up the volume and dive into this episode of State Tax Talks. Ladies and gentlemen, welcome back to another episode of State Tax Talks with Joe Tantillo. I'm your host, Joe Tantillo, and I am joined today by an expert panel on sales tax and a number of other taxes, but sales tax is going to be our focus today. We got two frequent guests of the pod, Mr. Joe Endres and Mr. Josh Lawrence. Guys, welcome back to the show.
Thanks for having us again.
To all of our listeners out there who are subscribers, I just want to give a special thank you to you. And if you are not a subscriber, you can subscribe to this show for free on Spotify, YouTube, Podbean, Apple Podcasts, or whatever your favorite podcast platform is. Today, guys, we're going to be talking about sales tax issues in the context of construction companies and contractors, an area that I know both of you are extremely well versed in, and that there is an abundant amount of nuance when it comes to the payment and collection of sales tax, payment of use tax, and I think, if I am not incorrect, that this is also an area that has a fairly frequent audit presence as well, just given all of the different things that can go on and all the different purchases and sales that are being made. So I figure it makes sense for us to, start from the top where we do with any sales tax issue and talk about some of the basis nexus concerns for construction companies, probably most prevalent for people who are actually selling construction materials into a bunch of different states. So if either of you wants to take it away with some initial thoughts on nexus, let's go.
Yeah, this isn't an area where nexus is particularly prevalent as an issue, in part because, let's start from ground zero here. First, I think we have to ask, what is a contractor? What is a contractor and what do contractors do? That to me is kind of the baseline, because if you're a contractor, a whole different set of sales tax rules apply. In fact, you're going to see that in many ways, the sales tax rules that apply to contractors are backwards or the opposite of the rules that apply to just traditional kind of vendors of property. And that really is the distinction between what a contractor is versus what a regular vendor is. A contractor is someone who is performing a service, usually an installation service or a repair service, but it's someone who's doing something to property or with property. So it's not like someone who is just simply selling you a window pane, right? It's the person who's installing the window pane.
Right.
And that's what makes a contractor, the actual service of installing. And that's important because I think, as we've talked about previously on this podcast, the way the sales tax is set up is, in most states, and certainly in New York, all sales of tangible personal property are subject to sales tax, unless an exemption applies. So there's a broad presumption that if you're selling something tangible, it's taxable, unless you can point to something in the law that says it's not. For services, the opposite is true. For services, generally speaking, services are not subject to sales tax unless they're one of the few that are enumerated in the law specifically as being taxable. So here we have contractors performing a service. So the question is, all right, well, what service applies to these guys so that they have to worry about sales tax? And the answer is there are two services in New York's sales tax law that specifically make contractors potentially taxable or potentially subject to the sales tax. And that is basically maintenance and repair to property. Maintenance and repair to tangible property. So if my fridge breaks or my washing machine breaks and they come in and repair it, or maintenance and repair or construction of real property. So if I build a house or I build a building, those are both service-based transactions that cause someone to be a contractor and subject to the contractor sales tax rules.
Yeah, and it's interesting because of the way that the rules are flipped a little bit for contractors versus regular vendors of services and tangible property. A lot of states have made a pretty simple structure where they just say, okay, well, any person that's doing work on real property, we're going to say as a service provider, that's not taxable. Doesn't have to collect tax. But we're going to say that they're a consumer of everything they put into the building or buy. And that makes things pretty simple. Construction work, whether it's repair, maintenance, or construction, is non-taxable in a lot of these states. And the purchase of all the materials is taxable because they're deemed the consumer of all these goods. New York makes it difficult because that's not the case in all cases. The work to real property can be classified as either taxable, as a repair or maintenance, or taxable installation of tangible personal property onto real property, or it can be non-taxable as a capital improvement. And the result of that affects the taxability of the contractor's purchases. And that's one of the big things that trips up contractors, and we see a lot as the big issue in audits, is the use tax component there.
Right. So I think that, how I'm going to contextualize this in my own mind throughout the entirety of this conversation is my theoretical hypo, and this will be for the listeners out there, right, is we'll imagine that we're building a house from the ground up, just residential real property, and we'll think about all the different elements of, you probably have a general contractor and then a whole bunch of subcontractors that are going to be coming in and putting this house together and doing different aspects of it as it goes up from start to finish. So let's talk about, the kind of high level general contractor selling construction services for this house, right? Like, what are the concerns from the very top level? What do I need to be thinking about if I am that general contractor, just in terms of, my big sales tax issues? I'm the first person that the Johnny taxpayer hires to come in and do this construction of their new beautiful home.
What's funny is I don't think I've ever actually worked on a sales tax audit for a new build residential. Like we've done
all commercial, right?
We've done pools, we've done install pools and install all different
solar generating facilities.
Exactly, yeah. But never a residential house. Tons of buildings, right. Commercial properties, but no build. Anyway,
I guess that's an interesting initial question. Is there a distinction between residential real property and commercial real property? I'm not aware of one.
No.
Yeah.
Some states do. Some states do have that distinction. Connecticut's one, but not in New York.
So anyway, to answer, and let me just tie back that first question that you asked. You asked about nexus, and I went into, what the heck's a contractor? So let me just tie that to, close that loop. Generally speaking, because contractors are service-based providers, they have nexus where they're performing service.
Sure.
And that's typically how the start and the end of that issue, because they're actually physically performing some type of service. That's where they're going to have nexus. Okay, so now on to your second question, which is, we're going to build something. What do we do? The question that comes up, as a baseline, the first question is, well, what are you doing? What is the work? If it's something easy, like I'm building a house from scratch or a commercial property from scratch, that's going to be a capital improvement. I mean, you're creating real property. It's going to be a capital improvement. Mm-hmm. Now we'll get into the ins and outs of where on audit, the state auditors try to kind of tax portions of that. We can get into that. But as a starting point, that is a capital improvement. And the question is, okay, well, if it's easy like that, no problem, capital improvement, those rules are going to apply. But where I start is, again, what is the contractor doing? If they're building something from scratch, capital improvement. But if they're not, like what if a tree fell on your house and you have to repair a portion of the roof? That's not a capital improvement, believe it or not. If you were to take off the entire roof and redo it all from scratch, that would probably qualify as a capital improvement. But if a tree falls and a limb just damages one section and you need to repair a hole in the roof, probably not a capital improvement, because that is just a repair. And so that gets to, well, what the heck is a capital improvement? What's the distinction between, a whole new roof versus fixing a hole in the roof? And Josh, why don't you walk us through that?
So the regulations have kind of a quaint little example, but it doesn't help much. It basically says repairing some shingles on a roof is a repair, while replacing the entire roof is a capital improvement. But we've had cases where, there's millions of dollars of work at a shopping mall where they're replacing, entire 365-foot sections of roof and, 1 million square feet of parking lot, but not the entire parking lot. And it gets into this, sort of gray area where there's no real rule. But that's the basic distinction. And if you can prove that something is a capital improvement, then the contractor doesn't have to charge tax to its customer. It owes tax on the purchases for that job. But then if it's deemed to be a taxable repair, then the whole thing changes and the contractor has to collect tax and could be liable for not collecting tax from the property owner. And it also changes the taxability of the materials.
You would think that with capital improvements specifically, it would be pretty easy to create like a basic list of repeatable construction activities that are happening in most new builds that they could, just put in the regs. Like, see, here are examples A through Z of capital improvements.
Well, the state has tried to do that. So there is a publication 862, that literally lists page after page, kitchen, roof, on all the different things that will qualify versus won't qualify. So the tax department has tried to do that, but invariably questions still come up as to what is. But let's just reiterate exactly what Josh just said, because everything is going to flow from that. If you're a contractor and you're performing a capital improvement, you don't charge tax to your customer, but you do have to pay tax on your materials that go into the job. If you're doing a taxable repair instead of a capital improvement, then you do charge tax to your customer, but you don't have to pay tax on the materials that go into that.
Technically, you do. Technically, contractors are required to pay tax up front on all the materials they purchase. But if it turns out that the job they're performing is a taxable repair and tax is getting charged to the end user, they can claim a credit for the tax that they paid on the materials on that job. So there's no pyramiding of tax. But in reality, if you did not pay tax up front and you were audited for those technically non-taxable purchases, you can sometimes prove that, no harm, no foul.
Right.
Yep.
Why is it in the context of the law that they've decided to not treat, the person who's getting the real property or the house or whatever it is? Why has the state determined that that's not the end purchaser of the materials? Is it simply that logically, because those materials, the raw materials, are transformed into something else, and we feel it would be unfair to have the end customer pay the tax on that? I mean, I think that it feels like a situation where, if you have a contractor purchasing materials from somebody who's producing or fabricating them and then ultimately, quote unquote, selling them to a third party, that feels like it would fall into the sale for resale camp. But obviously that's not how capital improvements work, because it's transformed.
I mean, I think there are three reasons for the structure, although I'm using the word reasons very loosely here, right? Number one is, as a technical matter, when you create a capital improvement, you're creating real property, and we don't tax the sale of real property from a sales tax standpoint. So there is no sales tax on realty. You're creating realty. There's nothing to tax. From more of a policy perspective, I think we want to, help foster the development of the construction of new property in the state.
Right.
And, is this a way to do it? Well, you're technically not charging tax to the end customer. End customer is going to, bear the cost of the tax paid on the material, certainly. But at the end of the day, you're not charging tax on the service of constructing everything. So that it should be cheaper from a tax perspective, which incentivizes the construction and development of property in the state, which is certainly something the state wants to foster. And then lastly, there's kind of a practical reason for this. When a contractor buys a pallet of wood, 2x4s or drywall or whatever, they don't know at that point whether they're buying it for use in a capital improvement job or for use in a taxable repair. You just don't know.
Sure.
You might use some glass to build a new building. You might use other glass to repair a broken window. You just don't know. So this structure allows the contractor to, once the material is used on a particular job, have the corresponding tax treatment flow from that. Yeah. But that still leaves a question in my head. What is a capital improvement? How do we define what is a capital improvement? What's we said the parking lot and the roof and all that. How does New York define or determine capital improvement?
Well, the answer is they have a test that is very hard to actually apply in practical situations. And that test requires meeting three elements. The addition or alteration of the property has to, one, add significant value to the property, or appreciably prolong the life of the property. Element two is that the property has to be objectively, physically affixed to the real property so that its removal would either damage the article itself or the real property. And then third, it has to be intended to be a permanent installation. And in practical terms and in the case law, element one is relatively easy to meet. That's been applied to like a $5,000 like security closed circuit TV system for a small place. The second two is where the battles are kind of fought.
Right.
And it becomes very difficult to prove in some cases when you're talking about things like, I'm just thinking of cases out there, a baggage handling system at the airport. It's a piece of equipment, but does it become part of the real property? Is it real property, or could you remove it and go install it in somewhere else?
Is it like the little trolley that your bag comes out on at the end when you finish your flight?
I believe so. They didn't explain what it was in the case that I'm thinking of. It
seems pretty necessary for an airport, I would argue.
Sure. And in that case, it was determined that the way that was installed was, it basically became part of the real property.
Right.
You couldn't really cut it out and use it somewhere else.
Right.
But things like, there's a sort of a new frontier here with energy storage, where you've got $1 million lithium battery that goes into a housing, and it's installed on a concrete foundation, and it's bolted to that concrete foundation, and that's going to be there for about 30 years. But the guidance out there suggests that wouldn't be a real property, because you could technically just unscrew and unbolt that piece of equipment, bring it somewhere else, and reinstall it. So it becomes, for big projects like that, it can be $1 million decision.
I remember
just on that one point.
We had a case where it was for a large laundering facility, and they had these massive dry cleaning machines, literally taller than a person, like a person and a half, and they weighed just tons, and they were huge. They did these massive loads of laundry, and it was the same issue. It was just, look, there's this huge piece of equipment, you physically couldn't get it out of the building,
right.
And it's bolted to the floor, but could you technically, if you had to, get it out of there? That's the question. And,
right.
The state took the position that these massive dry cleaning machines were not capital improvements, because you could feasibly somehow get it out and remove it.
Well, we had a client that installed these enormous, or maybe just one, enormous proton treatment machines where you got proton treatment for cancer.
Cancer treatment, yeah.
And this thing had to be basically, the roof had to be cut open so that it could be lowered into the building and installed. And technically, perhaps you could have removed that without damaging it, but you'd have to take apart the roof again to get it out. And I think the conclusion there was that's a capital improvement. But the third element, the permanence test, goes sort of to the law of fixtures and things like whether you're a tenant on the real property that's installing this or a landlord.
Right.
And there's a lot of battles that are fought there too for things that are put into leased property. And there's a specific set of rules. I don't know whether we need to go into the nitty gritty on those, but basically there's a presumption that if you are not the owner of the property and just a tenant, you'll never meet the capital improvement test if your lease requires you to remove that item at the end of the term. And that's a basic rule, and it gets into a little more sort of nuances there. But those are some of the things that come up in applying this 3-part test.
Yeah, it's a weird situation where you have intent becoming an issue for sales tax purposes.
Yeah.
What did the parties intend? How do they intend to make it permanent? And you can have leases for long periods of time, long duration, where for all intents and purposes, for the life of that property, it is going to be there forever, or at least for the life of the property. But if the lease language is not the good kind of lease language, because there are, different types of language. If the property has to be removed, the auditors are going to argue that that's not permanent, even though it's there for the life of the property. If, on the other hand, it's there for a shorter duration, but the property, becomes the property of the landlord, and that's the language you have in your lease, well, that's the good language. That's the language that will support the, capital improvement position. So if you're doing any construction on a leased space, got to check that lease language and make sure that, you have the good language rather than the problematic language.
Yeah. Geez. Wow. And I already know the answer, but I'm going to ask the question anyway. Do different states have different standards for what becomes a capital improvement? And is capital improvement even the universal language of, alterations or improvements to real property?
It's funny. We just did a multi-state analysis for a client of like maybe 20, 24 states or so. And I mean, not every state uses capital improvement. I mean, that's not a universal definition throughout, but we have found that there are patterns that emerge. And one of the patterns that comes up is this idea of permanency, and how the installation is affixed. So permanency is definitely something that comes up over and over again in states. But as Josh said at the outset, some states just take the position that if you're doing something with realty, we're not going to tax it. It's just much more blanket than New York's position, which is, well, what specifically are you doing to the realty?
Just to add to some of the nuances of the capital improvement test, again, there's one aspect that comes up a lot in litigation and advisory opinions and audits, and that's the end result test. And so you can have some work going on in a building that involves half repairs and half new additions to the property. And the question is, whether the entire project is taxable or non-taxable. And there's a test that's in the regulations that applies that basically says that if the end result of the services performed on real property is a capital improvement to real property, then the service is non-taxable. And this has come up in some big recognizable instances, one of which being the Woolworth building in New York City, which was, I think, a 70-story building that had a terracotta facade. And New York's rules require that you actually inspect and, maintain your facades so things don't fall on people when they're walking. And so they had a project that lasted for 5 years to basically look at each piece of the building's facade and each tile and replace it if necessary or repair it in place if necessary. And so it's a well-known case that applied this end result test and basically, held that even though there were repairs and lots of work that would normally not qualify, when you put it all together, the work resulted in a capital improvement. And so that becomes something in audits that we, employ a lot to try to avoid contractors getting dinged for, something being a repair when really the end result of the work is something non-taxable.
The Woolworth case, I get like that, is it a capital improvement? Or are you doing enough work to this thing so that you're completely causing a facelift to the building? Or are you just repairing individual tiles on the outside, which would normally be, a taxable repair? But what really gets me is more when you have a new construction and auditors are auditing the transactions that went into that new construction, everybody agrees it's a new construction. You're creating something that was not there before. Or you're doing a complete down to the studs build out of a new commercial space. And what auditors do, clearly this is a capital improvement, but what they do is they start taking apart little pieces of this clear new build. So it's not like you're fixing the Woolworth facade. You're creating a whole new Woolworth building.
Right.
But they'll still go into that whole new creation and start saying, hey, you know what? You know what doesn't look like a capital improvement? You know how those brackets that are, anchored into the drywall or anchored into the studs that hold TVs or hold audiovisual equipment? We get that the majority of what you're doing here is creating a new building, but we don't think those brackets are part of the capital improvement, and so they're taxable. And so they start kind of nickel and diming, nitpicking little components within a complete new build, something that is clearly a capital improvement.
Right.
And then we always start arguing, well, wait a minute, end results test to say this is all part of this new construction. And, always have fights on audit over that.
We actually won a case involving a bridge over the Gowanus River in New York City, I think it was. And basically the job was to repaint the bridge. That's not how we argued it, but the job was basically to strip this bridge completely down to its, the steel at its state when purchased and recoat this bridge with water-resistant, saltwater resistant paint and a special zinc compound that
this wasn't paint, this was epoxy. There was chemical reactions going on.
And so in this appeal, the tax department's position was, we have a regulation that defines what maintenance is and repair to real property as opposed to a capital improvement, and it lists painting as an example, and not painting of a brand new structure, but painting of an existing structure. And so we made a good case that this was way more than just paint. Way more. It was a coating. It was designed to keep this bridge intact for 40 years. It wasn't just, and the end result test was the sort of winning formula there.
Right. These weren't just guys showing up with a couple of Behr paint cans and their overalls and brushes and just,
Right. So another aspect of capital improvements where battles are fought.
This is a great time to bring this conversation to a pause. We're going to take a break and we will resume our conversation on sales and use tax issues for contractors in part 2 of this episode next time. Until then, this has been State Tax Talks. I'm Joe Tantillo. We'll see you soon. Thanks for joining us for another episode of State Tax Talks. If you're interested in listening to more episodes, we're available on all platforms where podcasts can be found, including YouTube. If you enjoyed this episode of State Tax Talks with Joe Tantillo, please give us a 5-star review on your favorite podcast platform. And if you're in need of a tax professional, you can contact the tax attorneys at Hodgson Russ. Go to www.hodgsonruss.com for more information. And until next time, I'm Joe Tantillo, and this is State Tax Talks. Catch you later, tax fans. The comments contained in this podcast do not constitute legal advice. The opinions herein are the opinions of the speakers and not the official opinion of the Hodgson Russ Law Firm.